Dear viewers, good afternoon to you. I am H.S. Bhat, a retired banker. Presently, I am an advisor in banking domain area to the reputed firm Funds Tiger, Bangalore. I am covering briefly about the net worth statements. Any financial institution, when one approaches for a loan, they will ask for a net worth statement. Net worth statement is nothing but details of the assets, details of liabilities as on a particular date, and excess of value of assets over the liability figure. That gives the net worth. Now I am actually coming to the case of an individual. An individual may have assets. Assets again, liquid assets, which are easily realizable into cash, and non-liquid assets, which are not easily realizable in cash, but only after a course of time it can be converted into cash, say like an immovable property. To sell it and get the money, it normally takes time. That is why it is called illiquid or not liquid asset. So in the case of an individual, when we prepare the asset and liability statement as on a particular date, it is prepared in the following pattern. First, under the asset side, priority wise, first item covers are liquid assets. So I am actually giving only an illustration. It is not actually complete or exhaustive. Say in the case of an individual, minimum cash will be kept at all times. So cash or cash equivalent, that is one head. Next is bank balance. Bank balance can be easily drawn. Bank balance at credit, maybe savings bank account, current account, even the term deposits, because term deposits also when required can be closed prematurely. So that is liquid asset. So second category of items is this balance with the banks or bank deposits. The third, cash is over, bank balance is over. Third is other liquid assets. Other liquid assets like, say, insurance policy, amount paid, but full paid up amount is not the amount of amount that can be taken for computing net worth. It is only the value we get in case we surrender the policy. That is, surrender value of a policy is taken for the purpose of computing net worth. Then there may be investment in mutual funds, investment in shares, investment in debentures, investment in national savings certificates, investment in Kisan Vikas certificate, or investment in bonds. All these things are also taken under the head assets. Finally, immovable assets. Immovable assets are nothing but land and building. The value of that is taken under the asset side. So a total of all these things, that will compute the value of total assets. Then let us coming to the liability side. Liability side, there is actually no difference between liquid and illiquid. All the liabilities are liquid. When demanded, on demand, we have to clear the liabilities. Unless otherwise, liability is to be liquidated over a period of time. Under the liability side, so bank loans, whatever are the existing bank loans, maybe personal loan, housing loan, vehicle loan, any other loan, all these things are taken for the purpose of computing liability statement. So credit card payables, that also is added under this, and this total figure we can say liability to the banks and financial institutions. That is one head. Second head, unpaid tax, that is income tax which is not fully clear, that is a liability that is taken. Then other liabilities, whatever other liabilities are there, that is taken. So all this added together, that forms the total liability. In some cases, if we have given guarantee to somebody for a loan, and if that loan has, that guarantee is not still cleared, that also is taken as a contingent liability. A portion of that may be added to the liability side. So after totaling the liability, if it is deducted from the assets, remaining value is the net asset value. So normally banks very much depend on the net asset value or net worth of the individual while giving the loan. This is as far as personal assets and liabilities are concerned. In the case of firms where audited statement of accounts are available, balance sheet is the main document relied upon to assess the net worth. First of all, if we see asset side of a balance sheet, capital and reserves, these are the funds belonging to the owners of the firm. So that is forming one head of asset, that is capital plus reserve. The credit balance in the P&L account, that is also coming in the liability side of the balance sheet, yet that is actually adding to the worth of the company. So that is also credit balance in profit and loss account, and if that profit is not intended to be drawn but it is intended to be capitalized, so that is also added while computing the net worth of the particular firm. So thus total asset value side will come capital plus reserve plus then credit balance in the P&L account. Then from the liability side, things to be deducted from the total asset value are preliminary expenses not written off, then loss appearing in the profit and loss account shown in the asset side, then in any intangible assets, these things are deducted. That forms the net worth of the particular firm.